of what the margin picture of the company looks like, because 70% of your revenues come from your gold and jewelry business, on which the margins are as low as about 3.5%. So going forward, what is the scope or what is the plan to improve the margins for the company, and what is the sustainable level for EBITDA margins?
Good afternoon, viewers. Getting into the question that you have asked, is basically, currently the market, what we see is, compared to last year and this year, since there was a 70% of our entire margin, entire business revolves around SRS jewels. Besides that, we also have cinema exhibition and retail to do this. So now in this season, what we see is that we look at the something towards the similar way, which is the market trend which we are seeing it, and we hope to see it in a much better fashion.
So could you tell us what the sustainable level of margins, EBITDA margins for the company would be going forward?
See, SRS Limited currently what we see is somewhat around 145 crore EBITDA margin is what we are looking at, with the turnover of somewhat around last year. What we did was 3,900 crore.
So that's close to about 3.5%. Is that where the margins will sustain going forward as well?
And we feel slightly better because as far as the numbers are concerned, since 10th, our results and everything are about to come out. So we feel after that we'll be in a much better position to talk, because when the half-yearly results close, it gives a much better picture.
Okay, fair enough. But very roughly, EBITDA for FY16 should be about 145 crore, which compares with 137 crore that you saw in the prior year. But Mr. Singh, most of your revenues comes in from the jewelry space, close to about 70%. But you also have presence in cinema and retail, as you pointed out. Between these two, between the two segments, could you tell us the growth plans? What's the kind of investment and the kind of revenues that you expect from the cinema as well as the retail space?
Ma'am, with respect to cinema, currently we have around 57 screen running, and we are looking at 100 screen coming up in next calendar year. So that would give us, currently the last year which we did was 93 crore business is what we did in cinema, and we are hoping to look at somewhat around 150 crore approximately this year. And then the retail, which has done 211 crore. We have got 45 stores running, and we will be coming up with somewhat around 70 stores by end of calendar stores. Jewelry store, retail store is currently we have got 10 stores, and we are coming up with 15 stores, and then one manufacturing unit, which most probably will be based out of Gurgaon. So currently we see a lot of good things, and overall even the cinema business has done picking up very well. So we see a lot of good things coming up this year and to be sustained next year.
Mr. Singh, you have plans to take your cinema number of screens from 57 to 100 in the next 1 year. What is the kind of funding that is required for that? Because you already have about 600 crore worth debt on your balance sheet, and your interest coverage ratio is somewhere 2 times, because for every 2 rupees you make in EBITDA, 1 rupee goes out in interest. So what is the funding plan as far as increasing the number of screens are concerned?
See, it is basically from our internal accrual as well as the funding from the various consortium that we have, which we have. So that is what the plan is. So
will you be taking on more debt?
Sorry?
Will you be taking on more debt to fund these screens?
Yeah, the planning is somewhat that. So we will only be able to see once our half-yearly results come out, and see that where we stand, and then we will take it forward.
Okay. But apart from the kind of capex that you're doing, which could impact your debt, do you have any plans to reduce your debt? Any other methods by which you could deleverage your balance sheet?
Ma'am, currently we are very, very aggressive with respect to our expansion plan and footprint across the north as well as the rest of the country. So what we feel is that, it is basically the investment which is going to take us to a different level altogether. So we feel that we need to be a little more aggressive on this, and then depending upon how we fare, and then we will take a call.
All right. Thanks a lot, Mr. Singh, for joining us and